What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll talk about robo-advisors. Just in case you're not familiar with the term, what are robo-advisors? In the past, people would have a financial advisor, and these guys would often advise about your portfolio selection, about different stocks, and they would also provide execution. They would go ahead and take orders from you as well. But of course, as with many things today, we're finding ways to replace human labor with algorithms, with computers, and this is just one more example of that, of replacing that human advisor, trying to replace that human advisor with an algorithm instead, with a program. So in other words, there's some amount of assets that typically you would give a financial advisor to take care of. Well, you can put a part of your assets or an account that you have under the care of one of these robo-advisors. Popular robo-advisors include Wealthfront, which was recently acquired by UBS for I think $1.4 billion. Interactive Advisors, which is related to Interactive Brokers, which is one of the great sort of international low-cost brokerages. Then, of course, also Betterment. Vanguard has their own now as well. Personal Capital, one of the OGs of the robo-advisor segment, though they also offer human advisory as well. M1 Finance, E-Trade, and Merrill Lynch. Well, now Merrill. So really, what's the selling point here is its cost. The fees on these can be anywhere from as low as 0.2% of the assets under management, up to maybe as high as under 1%. But previously, the advisors would be taking 1% or more, and then if you factored in all of the other costs that came along with that, then there's really potentially significantly huge savings. So let's kind of dig into that a little bit more, and this is where it's I don't know if it's really a double-edged sword, but there are pros and cons, right? So if we go back to the old model, and this is kind of funny, I like to look at Edward Jones as one of the prime examples of this. They're kind of famous for having these little physical offices, kind of in every town. They've got these little agents everywhere that kind of set up shop. And I don't want to say that they're predatory, but I will say that generally, in terms of the fees and everything, they're extremely aggressive. So oftentimes, they would take 1% management fee, and then they're also famous for putting their clients into mutual funds that have loads. These are things that these days on Schwab or Vanguard or Fidelity or what have you, you don't have that. You don't even have expense ratios a lot of the time these days. But with Edward Jones, they would put you in these American funds with a 1% load on the front end and then maybe a 0.75% load on the back end. So not only would you be paying the Edward Jones guys to manage your money, but every time they had you buy something, they would take a percentage off of that because the agent got a commission off of that, right? And then when you sold, they would also get a cut off of that. Not necessarily Edward Jones, but the fund, right? The fund company. And then obviously they're providing kickbacks to Edward Jones as well. I don't know the details of the model, but you can kind of see how the money is going there. And then they would also practice what's called churn. So they would always be getting you in and out of funds, so you continue to pay these fees as they rotate you from one fund to another. So a pretty brutal, very expensive way to have your money managed. I guess compared to doing nothing at all and not wanting to spend any time doing any research, it's better to at least be investing to some degree. But man, you're getting killed compared to what you could be doing with a little bit of diligence and reading and other options. So how bad are you getting killed? Well, there's this great chart on investor.gov that will show you the impact of fees over time. And the thing about it is, we've talked about compound interest and how powerful that is, how really just time in the market is much, much more powerful than timing the market, and much, much more powerful than how much you can invest. Because small amounts invested many, many years ago, compounding growth over time, is just way, way more powerful than, say, trying to catch up in the last 5 years before retirement and try to save a ton, right? It's really, really crazy how powerful this compounding is. But this also works for the fees, right? So The chart from investor.gov shows what would happen on an investment of $100,000. You can scale that down in your head, just cut off a decimal everywhere if you want to think about $10,000. But in any case, if you were to have a fee of 0.25%, so a quarter of a percentage point, also known as 25 basis points, after 20 years at a growth rate of only 4%, you would have $210,000. So you'd have 2.1 times your money, even after paying a 0.25% fee. However, if those fees were to go up by another 25 basis points to half a percentage point, then that would take away $10,000 from your gains, so quite a significant portion. That's 10% of your original investment. And if the fees were even larger at 1%, then you'd be losing $30,000, which is a very significant share of the $110,000 that you could have gained in the baseline scenario at 0.25%. And now we're talking about 30% of the principal balance as well. So you can see that these lines are diverging over time. And if we were to extend the time horizon to 30, 40 years, then these small changes in fees, 25 basis points here, 25 basis point there, really add up to tremendous amounts over the long run. So they are important to factor into. So this is the really big benefit of the robo-advisors, of course, is that you're going from paying those 1% fees or more, in the case of Edward Jones and the like, to paying less than 1 percentage point. In many cases, again, around 0.25, 0.35%, something like that. So what's the con? Well, one, of course, you lose the human element. So you no longer have, Bob or whoever at the office that you can call and say, Bob, stocks are doing terrible, but what do I do? And then Bob, of course, would probably then tell you, oh yeah, you were overweighted in this sector, we need to dump it. And he wouldn't tell you this, but he wants to turn you into something else, and then he'd make commission. Anyway, so yeah. Now, they're not all like that. These days especially, the landscape has changed a lot, thankfully, I think in a way that's beneficial to consumers, or to investors, sorry, because of the increased competition that's out there. But in any case, the robo-advisor won't be able to answer those questions and kind of do the hand-holding and all that stuff. They will just be automatically following whatever the parameters are that we've set up. And in that way, that's actually pretty good, right? Just having it automatic tends to be a much better way to do things, rather than continually tampering the portfolio and allowing our psychology to most likely reduce returns for us. Along these lines, though, however, is the fact that, of course, the human could be asked to devise a much more tailored strategy to your needs. Just trying to, not Edward Jones, but assuming you had this awesome financial advisor somewhere. They might be able to do things that are really not cookie cutter. Whereas if you're using a robo-advisor, then they're only going to have so many options available on the website. And of course, there is a spectrum here where, personal capital will have a certain amount of options, but others will have a larger variety of options. I think places like, I think M1 Finance is pretty good for sort of a more advanced investor, or the Interactive Advisors as well, I believe, is that way. I'm not familiar with all the platforms, just a general idea. And of course, I encourage you to do more research on your own if you're interested in this kind of thing. So kind of to restate, the pro of the robo-advisors is that we have a lower fee structure, but the con, of course, we gave that up in exchange for having a human, so we don't have the human interaction, we don't have the hand-holding, and we also have probably less portfolio customization. However, at the same time, this automatic nature of the investment is probably going to generate less haphazard behavior, haphazard investment behavior than you would have otherwise. Unless, of course, you're logging into your account and messing with it all the time, then it's going to be just as bad, and there won't be anyone to tell you not to. But while we're on the topic of fees, so again, these robo-advisors are not all created equal. They have sort of different qualities of interface, so you'll want to find one that has an interface that's intuitive and useful for you. They also vary in terms of the fund selections, and then they also vary in terms of the fees that are charged by the funds that they put you in. So again, on this topic of fees, very, very important. If you were to go with Vanguard, for instance, they would put you in Vanguard funds, which have very, very low fees. If you were to do that, with Schwab, for instance, they also have some very, very low fee funds. But there might be some other robo-advisors out there that might put you into funds that have a higher fee structure. And so you'll be paying that along with the component that goes to the robo-advisor, say Wealthfront or Betterment or whatever, as well on top of that. Now, the next big benefit is also a major double-edged sword that I want to talk about. So most of these products are kind of marketed towards you using an after-tax brokerage account in order to invest with them. And so then they can also advertise the fact that they can do something called tax loss harvesting. So I've talked about this in previous videos. You can essentially step down your cost basis by selling shares that have depreciated in value and then buying something similar but not identical. And then after 30 days, if you want, you could go back to the original holdings as well. So it's really just a way to book a capital loss during a tax year in order to reduce your tax liability at that time. Now, of course, your basis has changed, and so you will have to pay on those capital gains eventually at some point. But time value money and all that seems to make sense to do some tax loss harvesting now, rather than worrying about what may or may not happen many years in the future. And you can always have some strategies to manage that. So in any case, these robo-advisors, again, do target you to be using an after-tax brokerage account, which of course is not tax sheltered, so these tax strategies have a place. And they also, tell you that they will do automatic tax loss harvesting. So they will identify these opportunities to sell funds at a loss and then, shift your holdings to something similar that's still in line with your overall goals. And in this way, they can help to reduce your tax liability. So this sounds great. However, the double-edged sword and the big one, and one of the reasons why I definitely didn't want to go with one myself, is that then some of you might be already ahead of me on this and thinking about it, but if there are tax consequences when you buy and sell, then let's say you're not happy with the service that's being provided by your robo-advisor and you want to get out. Well, this could be tricky because they might have put you in a crazy portfolio, and there will be tax consequences if you wanted to fix it, right? If you wanted to sell everything and then invest in something else, but these shares have appreciated. Let's say you were working with this company for, I don't know, a year or two, or maybe it just happened to be, quite a bull market during the time that you were working with them, but then you're not happy with them, then you're kind of stuck. It's going to be difficult to unwind this portfolio. So that's one kind of big double-edged sword about it. Like, yeah, maybe they can do the tax loss harvesting, but at the same time, you might end up with this crazy complex portfolio that you're kind of stuck with in a certain sense, right? Unless you want to pay the tax man. And so that's why, at least for me, this major selling point of the robo-advisors, which is the tax loss harvesting, is absolutely not a selling point for me. If I were to go with one of these guys, I would be more likely to do it in a tax sheltered account, so that if I'm not happy with the service, it could start off really good, right? But let's say something happens, management changes at the company and things go south, you would want to be able to switch gears at some point. Now, if it's in a tax sheltered account, like a Roth IRA or a traditional IRA, then you have the capability to just liquidate the portfolio and then reinvest with someone else or do whatever you want without having to worry about these tax consequences. And so for me, that would be much more preferable. But in general, what do I think about robo-advisors at all? Well, kind of like I was saying previously about working with Edward Jones or a company like that, is that maybe it's better than having done nothing. But man, can it be expensive. So even this is 0.25%, again, if we're not taking the benefit of the tax loss harvesting, which I don't think is a good idea for me, then that 0.25%, or even in the case of Vanguard, 0.2%, that's 20 basis points of my gains that I really don't want to give up for no reason, right? Because I can replicate what they're doing on my own just by being a DIY investor and being disciplined. So, either way, before making the decision, I think it would be a really good idea to understand about investing, about what the funds are that, what are the asset classes that this robo-advisor is putting me into? What is my money being invested in? What is the strategy behind it? So to learn a little bit of the basics about investing, I do have a video actually, quite lengthy, but I think in one of my early videos, so not a whole lot of people watched it, but it really talks a lot about sort of, an introductory guide to investing, and I think there's really great content in that video, so I will link that below. But then the funny thing is, all right, so we've already done the research to understand about investing in order to know what we're getting into with the robo-advisors. Well, now that we've understood all this stuff, then we might as well just do it ourselves, right? At least that's my thinking. You may disagree. Maybe you like the idea that, they can kind of just do it for you, and maybe just having that sort of convenience is worth 25, 35 basis points or what have you. I don't know. I mean, it really adds up to quite a lot of money over the long run. But if you are going to do that, then, again, things to consider would be how good is the platform? What kind of strategies do they offer? What are the fees that are charged both by them and by the funds that they're going to put you into? And then also, as we talked about a moment ago, do they offer the service for tax sheltered accounts and not just taxable brokerage accounts? Again, in case you might not like the idea of getting stuck with a taxable portfolio that you can't liquidate without major tax consequences. I guess one last thing to mention that is kind of helpful about these robo-advisors though, is they do allow you to set up different goals and kind of track your progress, and they kind of can help you towards meeting those goals. I saw some of that on the Vanguard interface. It looked kind of cool. So, it isn't useless. It's just a matter of whether or not you think that that it provides an adequate return on the fees that you're paying them in exchange for that service. So that's for you to decide. But hopefully this video at least gave you kind of a framework to think about that decision and introduced you to the topic of robo-advisors. If you hadn't, and if you were working with a traditional human advisor, again, that can also be good too if they're earning their keep. But just from history and sort of my experience, well, anyway, I think you can get my thoughts on that one personally. But anyway, hope this is a helpful video. If you found it helpful, please do hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.